Welcome, everyone. Today we are going to explain how you can see the order book for a stock and how it can help you make smarter trading decisions. By the end of our time together, you will know exactly how to access the order book, how to read it, and how to use that information to gain better insights into the market. Let us start with a question for you. Have you ever wondered why stocks move the way they do, or how you can get ahead of those moves before they happen? Imagine being able to foresee these moves before they happen, giving you the confidence to act before the rest of the market catches up. Well, stick around because understanding the order book is like having a window into the secret world of buyers and sellers. This is the kind of information that can help you decide when to jump in or stay out. Along with understanding the order book, we will also explore common chart patterns that can help you identify opportunities. Chart patterns are visual representations of price movements that help predict future behavior, and understanding them can be a powerful addition to using the order book. Let us go through some of the most important chart patterns, such as head and shoulders, double tops and bottoms, flags and pennants and triangles, and see how they can help inform your trades. First, let us talk about the head and shoulders pattern. This pattern is used to predict a reversal in the price trend of a stock. It looks like three peaks, where the middle peak is the highest, resembling a head with two shoulders on either side. When you see this pattern forming, it usually means that the price is likely to change direction soon. The opposite of this is the inverse head and shoulders pattern, which often signals a potential move higher after a downtrend. Recognizing these patterns can be crucial for timing your trades effectively. Next, let us discuss double tops and double bottoms. A double top is when the price hits a certain level twice but is unable to break through, which signals that the price might start falling soon. On the other hand, a double bottom is when the price falls to a certain level twice but cannot go any lower, indicating that it might start rising. These patterns are useful for identifying when a trend might be ending and a new trend might be starting. Another important chart pattern is the flag or pennant. Flags and pennants are continuation patterns, meaning they signal that the current trend is likely to continue after a short pause. Flags look like small rectangles and pennants look like small triangles. If you see a flag during an uptrend, it often means that the price is going to keep moving up after a short consolidation period. Similarly, a pennant can indicate that a downtrend will continue after a brief pause. Triangles are also very common and come in different types, such as ascending, descending, and symmetrical. An ascending triangle has a flat top and rising lower trend line, which usually signals that the price is likely to break out higher. A descending triangle has a flat bottom and a declining upper trend line, which often suggests that the price is going to break lower. Symmetrical triangles, on the other hand, can break either way, and traders watch these closely for signs of which direction the breakout might take. Chart patterns give you a visual way to understand price movements, and they are very powerful when combined with the order book. For example, if you spot an ascending triangle pattern and you also see large buy orders piling up in the order book, that can give you extra confidence that a breakout to the upside is likely. On the other hand, if you see a double top pattern forming and the order book shows a lot of sell orders at a certain price level, it may be a good signal to exit your trade before the price starts to fall. Understanding these patterns and combining them with what you see in the order book can provide a more complete picture of what is going on in the market. Keep practicing, and soon you will be able to spot these chart patterns easily, and you will know how to use them alongside the order book to make more informed trading decisions. Stick with us to learn more about these key patterns and how they can work alongside the order book to make your trading decisions even stronger. The first thing we are going to do is answer a very basic but important question. What is an order book? Simply put, the order book is a real-time list of people who are trying to buy or sell a particular stock. It tells you how much people are willing to pay and how much they want to sell for, and also in what quantities. It is a critical tool because it tells you the depth of the market. That is just a fancy way of saying how many shares are available at each price level. It is like peeking under the hood of a car you want to buy. You want to know everything that is going on so you can make the best possible choice. The order book is especially valuable because it shows you the relationship between supply and demand in real time. You get to see if there are more people wanting to buy than there are people wanting to sell, and at what prices. You can use that information to make much better decisions. Let us dive into how you can access the order book and start using it to your advantage. The first thing you will need is a trading platform. It does not matter which broker or app you use because almost all of them have an order book feature. You just need to know where to look. So here is the simple process. First, open up your trading app or platform. Then type in the stock you want to see. This is usually done by typing the name or ticker symbol of the stock. Once you have got the stock pulled up, look for an option that says order book or sometimes depth of market. It is often near the chart or listed among the details for the stock. Now let us expand on chart patterns because these can be powerful tools to help you make trading decisions. By using chart patterns, you can predict future price movements, making it easier to decide when to enter or exit a trade. We are going to cover a few more essential chart patterns that every trader should know. First, let us dive into the cup and handle pattern. This pattern looks like a teacup with a rounded bottom followed by a smaller consolidation period that forms the handle. The cup and handle pattern is a bullish continuation pattern, meaning it often signals that the price will continue moving higher. When you see this pattern, it is often a good opportunity to buy as the breakout from the handle can lead to a significant upward movement. Another important chart pattern is the wedge pattern. Wedges come in two types, rising wedges and falling wedges. A rising wedge usually forms during an uptrend and indicates a potential reversal, suggesting the price might start falling. A falling wedge, on the other hand, is a bullish pattern that forms during a downtrend, indicating that the price might reverse and start moving higher. Spotting these patterns early can give you an edge by helping you predict when a trend reversal is coming. We should also talk about rectangles. Rectangles are continuation patterns that indicate a period of consolidation before the price continues in the same direction. If the price breaks above the top of the rectangle, it signals a continuation of an uptrend. Conversely, if the price breaks below the bottom of the rectangle, it signals a continuation of a downtrend. Rectangles are useful for setting clear entry and exit points, since the breakout direction often provides a strong signal for the next move. The next pattern we will explore is the triple top and triple bottom. Similar to double tops and bottoms, triple tops occur when the price reaches a resistance level 3 times without breaking through, suggesting that the price may soon fall. Triple bottoms are the opposite, with the price hitting a support level 3 times, indicating that it might rise soon. These patterns are particularly useful for identifying stronger support and resistance levels compared to their double counterparts. Another classic pattern is the rounding bottom. This pattern looks like a U shape and indicates a gradual reversal from a downtrend to an uptrend. It often signals a long-term buying opportunity as it shows a slow shift in momentum from sellers to buyers. The rounding bottom is often followed by significant upward momentum, making it a great pattern for longer-term traders. Lastly, let us discuss the bullish and bearish engulfing patterns, as well as some additional reversal candlestick patterns that can provide key insights. Bullish and bearish engulfing patterns are candlestick patterns that signal a potential reversal. A bullish engulfing pattern occurs when a small red candlestick is followed by a larger green candlestick that completely engulfs the previous day's range, indicating a potential reversal to the upside. A bearish engulfing pattern is the opposite, where a small green candlestick is followed by a larger red candlestick, signaling a possible reversal to the downside. These patterns are powerful when they appear near key support or resistance levels. In addition to the engulfing patterns, there are other key candlestick patterns that traders should be aware of, such as the morning star, evening star, hammer, and shooting star. The morning star is a bullish reversal pattern that occurs at the bottom of a downtrend. It consists of 3 candlesticks, a large red candlestick, followed by a small-bodied candlestick that can be red or green, and then a large green candlestick. This pattern suggests that the selling pressure is subsiding and buyers are starting to take control, indicating a potential upward reversal. The evening star is the bearish counterpart, occurring at the top of an uptrend and indicating a potential reversal to the downside. The hammer and the shooting star are also important patterns to understand. The hammer is a bullish reversal pattern that forms after a downtrend, characterized by a small body with a long lower wick, showing that buyers stepped in after sellers pushed the price down. The shooting star, on the other hand, is a bearish reversal pattern that forms after an uptrend with a small body and a long upper wick, indicating that sellers pushed back strongly after buyers initially drove the price higher. By recognizing these patterns and using them alongside the order book, you can better identify potential reversal points in the market. For example, if you see a hammer pattern forming near a key support level and the order book shows significant buy orders at that price, this can be a strong signal that the price may soon start moving upwards. Similarly, if a shooting star forms near a resistance level, combined with an order book showing large sell orders, it may indicate an upcoming price decline. Learning these candlestick patterns, in addition to the engulfing patterns, will help you develop a well-rounded approach to trading decisions. Chart patterns provide valuable insights into the psychology of the market. By understanding these patterns and combining them with the order book data, you can make more confident trading decisions. For example, if you see a cup and handle forming and notice large buy orders piling up in the order book, this gives you more confidence that an upward breakout is likely. On the other hand, if you see a rising wedge and the order book shows many sell orders at higher price levels, it might be time to prepare for a potential drop. Keep practicing these chart patterns and work on combining them with the order book data. The more you practice, the easier it will be to spot opportunities and take action. With time and experience, using chart patterns along with the order book will become second nature, giving you the confidence to make well-informed trading decisions. When you open the order book, what you will see are the buy orders on one side and the sell orders on the other side. Buy orders are sometimes called bids, and sell orders are sometimes called asks. If you are wondering what this really means, think of it as a list of people waiting in line. Some people are lining up to buy at different prices, and some people are lining up to sell. The people willing to pay the most to buy are at the top of the list, and the people who want to sell for the lowest price are at the top of their list. What makes the order book interesting is that you do not just see the current price. You also see a whole list of prices above and below the current trading price. This list gives you a sense of the market's depth. You can see how much buying and selling interest there is and at what prices. For instance, if there is a lot of buying interest at a particular price, that could mean people believe that price is a good deal. Now let us talk about some key ideas you will see in the order book. The best bid is the highest price someone is willing to pay, while the best ask is the lowest price someone is willing to sell for. These two prices together give you the current market quote. If you look closely, there will always be a difference between these two prices, which is called the spread. A narrow spread means that there are lots of people ready to trade at similar prices, indicating strong liquidity. A wide spread, on the other hand, means that buyers and sellers are not really agreeing on what the price should be, which can result in lower liquidity. When the spread is narrow, the stock is often more liquid, which means it is easy to buy or sell without a significant price impact. When the spread is wide, you might have a harder time getting in or out without affecting the price. Another key concept related to the order book is market depth. Market depth refers to the volume of buy and sell orders waiting at different price levels beyond just the best bid and ask. The deeper the market, the more stable the price tends to be, since there are larger numbers of buy and sell orders distributed across various prices. This means that a deep market will often be less susceptible to large price swings from a single transaction, making it more predictable for traders. In addition, the concept of support and resistance plays a big role in understanding the order book. Each price level in the order book shows how many shares are available to buy or sell at that level. If you see a lot of shares at one price on the buy side, that can indicate a strong level of support. Support means there are a lot of buyers at that price, so the price might have a harder time dropping below it. On the other hand, if there are a lot of shares at one price on the sell side, that can mean resistance. Resistance occurs when there are many sellers at a given price level, making it challenging for the price to move higher. Recognizing these key levels can help you decide when to enter or exit a trade, as well as when to place orders to improve your chances of execution. Another thing to watch in the order book is how buy and sell orders behave in real time. For example, if you see large buy orders suddenly appear or quickly get filled, it can signal strong demand, suggesting an upward move might be imminent. Similarly, large sell orders being filled can indicate selling pressure, suggesting a potential downturn. Understanding how the market depth and the balance between buy and sell orders evolves during the day is crucial to making effective decisions. Market depth not only shows you where buyers and sellers are, but also gives you insights into potential turning points in the price based on the accumulation or disappearance of large orders. Additionally, it is important to understand the dynamics of hidden liquidity. Sometimes traders place hidden orders that are not visible in the order book. These orders, also called iceberg orders, can influence the market without being readily apparent to most traders. Hidden liquidity can make it challenging to gauge the true depth of the market, so combining order book analysis with other indicators, like trading volume and price action, is important for getting a full picture of what is happening. By understanding these key ideas in the order book, including the best bid and ask, the spread, market depth, support and resistance, and hidden liquidity, you can gain a much better grasp of the forces driving price movements. This understanding will help you improve your timing for entries and exits and provide more confidence in your trading decisions. Each price level in the order book also shows how many shares are available to buy or sell at that level. If you see a lot of shares at one price on the buy side, that can indicate support. Support means there are a lot of buyers at that level, so the price might have a harder time dropping past it. On the other hand, if there are a lot of shares at one price on the sell side, that can mean resistance. Resistance means there are a lot of sellers at that price, which makes it harder for the price to move higher. Knowing how to use the order book can really help with your trades. For example, if you are looking to buy a stock, you might want to pay attention to where there are big buy orders. If you see a lot of people wanting to buy at a certain price, you might decide to place your order just above that level to make sure you get filled before others. On the other side, if you are already holding the stock, you might watch for large sell orders to see where resistance might come in. If there is a big pile of shares being sold at a certain price, it might be a good spot for you to think about selling too. The order book can also help you figure out the right timing for getting in and out of trades. One way to do this is by watching how quickly orders are being filled. If you see buy orders getting filled quickly, that can mean strong demand. It might be a good time to jump in before the price moves higher. If you see sell orders piling up and not getting filled, it might be a signal to get out before the price drops. Something else to pay attention to is market depth. Market depth just refers to how many buy and sell orders there are at different price levels. A deep market means there are lots of orders spread out across different prices, which helps keep prices stable. A shallow market means there are fewer orders, which can make the price move around more sharply. Liquidity is a big deal too. Liquidity refers to how easy it is to buy or sell without affecting the price too much. High liquidity means that the price does not change a lot, even if a large order comes in. Low liquidity means that even small orders can cause big price changes. You want to be careful trading in stocks that do not have a lot of liquidity, because you could end up moving the market just by placing your trade. Sometimes you will notice that the order book is not balanced. If there are way more buy orders than sell orders, or way more sell orders than buy orders, this is called an imbalance. This kind of imbalance can mean that the price is about to move. If there are a lot more buy orders, it could mean the price is about to go up. If there are more sell orders, it might mean the price is going to fall. Spotting these imbalances can help you jump in early before the price starts to move. You do need to be careful, though, because sometimes people try to manipulate the order book. One way they do this is called spoofing. This is when traders place big orders without really planning to buy or sell. They are just trying to make it look like there is a lot of demand or supply. This can trick other traders into making a move based on that fake information. Another manipulation tactic is called layering. Layering is when a trader places multiple orders at different price levels to create an illusion of market depth, which can lead to artificially influencing the price to move in a certain direction. Once traders react to these false signals, the manipulator cancels their orders, often profiting from the price movement they caused. The key to avoiding these tricks is to pay attention to how orders behave. If big orders appear and disappear quickly, they might be fake. Watch for patterns of behavior, such as repeated large orders that suddenly vanish before being filled. It is also helpful to use other indicators like volume or price trends to confirm what you see in the order book. Combining data from the order book with indicators such as moving averages, relative strength index RSI, and trading volume can help you differentiate between legitimate trading activity and potential manipulation. Another useful approach is to observe the time and sales data, also known as the tape, which shows actual completed trades. This can help you confirm whether large orders in the order book are being executed or if they are merely there to deceive. Another tip is to use the order book with other tools to get a full picture. For instance, if you see a lot of buying interest in the order book and the volume is also increasing, that is a strong signal the price might rise. Technical indicators can also help. For example, if the relative strength index or RSI shows the stock is oversold and you also see big buy orders, this could be a good time to buy. Here are some practical suggestions for using the order book. First, keep an eye on key price levels. The best bid, the best ask, and any large orders just above or below these levels can give you important clues about where the price might move next. Watch for sudden changes too. If big orders appear or disappear quickly, this could signal a change in sentiment, so be ready to adjust your trades. For those of you interested in shorter-term trading, the order book is especially helpful because it gives you real-time data. This can help you make quick decisions. You will be able to see when momentum is building and jump on those opportunities before they disappear. Be careful, though, not to overreact to small movements in the order book. It is easy to get caught up in every tiny change, but it is better to wait for a pattern or a trend to confirm what you are seeing. It is also important to keep the broader context in mind. The order book is just one piece of the puzzle. You should also pay attention to news and the overall market trend when deciding on your trades. A good way to get better at reading the order book is to practice. If your broker offers a demo account, use it. You can practice reading the order book and placing trades without risking real money. Keep a journal of your trades and review what worked and what did not. This can help you spot patterns and improve your strategy over time. It is also useful to try out different types of stocks, such as those with high trading volume and others with low volume, to get a sense of how order flow changes. So, let us recap. The order book is a list of real-time buy and sell orders for a stock. It gives you valuable information about how much buying and selling is happening at each price. It is great for understanding market depth, spotting support and resistance, and helping you decide when to buy or sell. The best way to get comfortable with the order book is to start practicing. Watch for key levels, and combine the information you see with other tools like volume and technical indicators. Learning how to read the order book can give you an edge in your trading. Keep practicing, stay patient, and soon you will be able to make decisions with more confidence. The more you practice, the easier it will become, and you will be on your way to making better and more informed trades. Stay engaged, keep asking questions, and keep learning.